The Indian rupee fell to record lows against the US dollar, breaching the 89 mark on November 21st when it touched an all-time low of around 89.48. It is now officially Asia's worst performing currency, falling 4.59% this year. This depreciation was driven mainly by four factors. First, a strong US dollar index, which rose above 100 due to the reduced expectations of Federal Reserve rate cuts and increased demand for dollar assets globally. Second, India's widening trade deficit, partly due to drop in exports to the US after new tariffs added downward pressure on the rupee. Third, market sentiment also remained fragile amid uncertainty over a long-awaited India-US trade agreement alongside increased foreign investor caution. Fourth, a significant selling pressure on the rupee. So now what happens if the rupee falls? Well, RBI intervenes to provide support to the rupee, and it did this time too, and it then rebounded slightly by November 24, trading around 89.16. When the rupee falls significantly against the dollar, Reserve Bank of India, which is the Central Bank of India, intervenes by selling dollars both in the domestic spot market and offshore non-deliverable forward markets. The RBI's intervention aimed to contain extreme volatility and support the currency from falling beyond the critical 90 per dollar level. The central bank's foreign exchange reserves also provided a buffer to absorb shocks and restore some investor confidence. While the RBI does not intend to defend a fixed exchange rate, it is focused on smoothing out sharp fluctuations and maintaining orderly market conditions. So now, does this impact you? The rupee's decline impacts the Indian economy and consumers in different ways. First, let's talk about the households. It makes imports costlier, which can push up prices of fuel, imported electronics, and travel expenses. This inflationary pressure can lead to a broader increase in costs over time. If you like to travel abroad, that will also become expensive for you because $1 will now be equal to over 89 rupees. On the corporate side, export-oriented sectors such as IT services, pharmaceuticals, and textiles benefit because their dollar earnings translate into higher rupee revenues. Meanwhile, import-heavy sectors like aviation and consumer durables face margin pressure due to higher input costs. For investors, sudden currency weakness often triggers cautious behavior among the foreign institutional investors, especially influencing the equity markets through increased volatility. So while some sectors benefit, most don't. What's next for the rupee now? Looking ahead, the rupee is expected to fluctuate within a range of roughly 88.4 to 89.5 in the short term as per some experts. Its trajectory will largely depend on developments in the US dollar strength, crude oil prices, progress in India-US trade talks, and RBI's response to market conditions. An eventual trade deal and softer global dollar momentum could stabilize or strengthen the rupee, while delays or heightened global uncertainty may push it further lower. What are your thoughts on this? Let us know in the comments, and like, share, and subscribe to ET Now for more such news and views.
If you like this video, then like, share, and subscribe to ET Now.